Welcome to Wealthy Behavior, talking money and wealth with Heritage Financial, the podcast that digs into the topics, strategies, and behaviors that help busy and successful people build and protect their personal wealth. I'm your host, Sammy Azuz, the president and CEO of Heritage Financial, a Boston-based wealth management firm working with high net worth families across the country for longer than 25 years. Now let's talk about the wealthy behaviors that are key to a rich life. Welcome to the April investment edition of the Wealthy Behavior Podcast, where I talk to Heritage Financial's Chief Investment Officer, Bob Weisse, about what's going on in the market and investment universe that you need to know right now. Bob, happy April Fool's Day. It sounds like your kids played some pranks on you this morning. We're recording on April 1st, if you haven't figured it out already, Tuesday morning for a Thursday release. But what happened at your house?
Yeah, April Fool's Day. My kids were all excited. I woke up looking for a spoon to have my oatmeal, and they took away all the silverware. And I was just like, recorded a podcast today, a lot of meetings, not really up for April Fool's pranks. Play the jokes on mom, please. Where's the spoon?
Yeah. And so are you doing anything back this afternoon?
I'm not.
You're not.
I'm not much of a prankster myself.
All right. Well, that's good to know. People probably appreciate that in a chief investment officer. So, Bob, we obviously want to recap the first quarter for people because that's typically what we do for the April recording. And it's been a very active first quarter, stuff that we've talked about in previous months, stuff I talked to Jeffrey Kleintop about, as well as Michael Santoli, just what's going on with the market and this volatility. So we're going to touch on that because we have to. I think clients are coming into our meetings somewhat pleasantly surprised that the headlines that they're seeing about how tough the market has been and this policy uncertainty. Portfolios are fairly resilient, which we can chalk up to diversification, and you'll hopefully share the details there. And then I also know that we want to chat about a new portfolio solution that we've been selectively implementing with clients, particularly those who have cash to invest versus a mature portfolio, or may be interested in some longer term tax planning in their investment portfolio.
Yeah, that all sounds good, Sammy. So I'll start with a quick review of Q1. So looking at index returns, MSCI USA, so US large cap stocks in the first quarter returned negative 4.6%, so about a 5% decline for US large cap stocks. Looking overseas at developed international equity, the MSCI World ex-USA returned a positive 6.2%, so a nice spread between developed international up 6, while the US was down 5. And emerging markets, the third region with an equity that we look at, MSCI emerging markets was up 2.93%, so about rounding up to 3%. So big picture, US down 5, developed international up 6, emerging markets up 3. And then if we look at fixed income, the Bloomberg US Aggregate Bond Index was up 2.78%. So really strong quarter for bonds as we saw a decline in interest rates. So some price appreciation in bonds in addition to collecting yield. So strong return from bonds. And then looking at real assets like REITs, real estate investment trusts, those were up about 1%. So that rounds out the allocation. We look at the MSCI All Country World Index as a measure of the total global stock market. It's about 2/3 US, 1/3 overseas, because the US has done well over the last decade. It's grown as a percentage of the ACWI. So the ACWI index return for the quarter was minus 1.32%. And that's from the US pulling it down with the minus 5% from US large cap stocks. Maybe one thing to dig into the US market a little more. I said MSCI USA was about minus 5. If you split US large between value and growth, so think value, more cheaper companies, typically better balance sheets, better income statements, growth companies, more the high flyers, tech, more expensive, more exciting. MSCI US growth was down 11, while MSCI USA value was up 3. So a pretty sizable spread between value and growth. So what we saw really in Q1 was a sell-off of the big tech names that had done really well in 2023 and 24. They started to come back down to earth a little bit. In our call earlier this year, we talked about concentrated consequences with themes of the concentration of the big tech names. And one of the issues is if those big tech names have a pullback, the whole market feels it. And that's what we saw in Q1.
So, Bob, maybe getting underneath the hood of that a little bit, and I appreciate that overview. And this is something I talked to Michael Santoli from CNBC about, and just asked him, based on his feeling and talking to investors, what has precipitated this U.S. market sell-off? And in his view, it was absolutely the policy uncertainty was a triggering event, even though valuations were very high. There was concentration in the U.S. There were these tech names that had really, been priced to perfection. Why would investors be indiscriminately selling off the most expensive area of the market if this is about policy uncertainty? Doesn't it seem like their valuations have to be a part of this?
Yeah, the way I think about it is if you think about investor sentiment and say put it on a scale from 1 to 10, where 1 is everyone's bearish and the world's going to end, and 10 is everyone's exuberant, everything's great, and there's no care in the world. I'm excited and I'll just invest money. We were close to a 10 not too long ago, 9, 10. And one measure that I think you can look at is cryptocurrencies. Like when Bitcoin is trading somewhere around 100,000, like to spend $100,000 on a Bitcoin that doesn't have a yield. I think things like that are a sign of froth in markets when people are, part with their money very easily. And a next level below crypto, I would say would be growth stocks trading at very extreme multiples. And when you don't really have fundamentals to back it up, but it's more almost hope and dreams of the future that like good things could happen. So when you have a more exuberant environment where investors are excited and really risk seeking, willing to take risk, leaning into risk. I think that's where we were. And then you have, as you said, a triggering event, politics, tariffs, that leads to more uncertainty. What happens is on that scale from 1 to 10, people went from say 9 or 10 and said, maybe we shouldn't be feeling like a 9 or 10 right now. Maybe I should be positioned more like a 6 because there's more uncertainty in the world. And what falls first? It's the more extreme assets, the ones that are priced up the most and least supported by fundamentals. So that's when, the spreadsheets come out, the calculators, pencils, and okay, like, is the earnings really going to be here to support this price? Is the balance sheet really strong enough, the assets to support this price? I think investors start asking themselves those questions more as their risk appetite goes down. So that's how I would tie the two together.
And I know we don't have a crystal ball, which is a clever way of me asking you to make some sort of a crystal ball prognostication. But instead of doing that, I will just maybe ask you, we've talked about it before, to re-explain momentum and this idea of things that, I'll have you explain it. And could that lead to these trends continuing versus sharp reversal? Because we're already starting to get the questions of, Tesla's down 50%, Nvidia's down 30%. Is this a buying opportunity? Should I go in and grab them? And we don't counsel on individual stocks necessarily, but just that sentiment of stuff's sold off, is it now much more attractive?
Yeah, so starting with momentum, momentum is basically a theory or characteristic typically of asset prices. And the idea is that winners keep winning and losers keep losing. And if you think about it, if you look at a price of a stock, it typically, will be climbing up for a little while, then it'll go down and it'll go up and won't look like an EKG, a heart chart that's just like bouncing up and down. Like by definition, a bull market it's a trend, or a bear market is a trend. And these things do tend to play out over time. When you look behind it, like why do stocks move for prolonged period of times in a certain direction? There's a few things. Everyone doesn't act at once. Like some investment committees might meet quarterly and they're all having similar processes, but acting on different days. So it takes time for information to trickle in. That's one. Another pretty big one is behavior. As much as we know about human behavior and how people like to chase returns, it doesn't stop people from doing it. So you have a winner and it's winning, it's doing good, it's doing well. What happens? More people buy it. Oh, the stock's hot. I got to get in it. And then meanwhile, something's losing, it's underperforming. Believe it or not, people are selling. Oh, this thing's a dog. I got to get out. And it just kind of compounds the effect. So there's a number of reasons why momentum exists. But the point is that you typically, one of the sayings in Wall Street is don't try and catch a falling knife. Something's underperforming and don't get in there too quickly. And I think that the very first podcast we recorded was in January of 2022, I believe. And you asked this same question, Sammy. The tech stocks just started to sell off. They were FANG at that time, and it was like, okay, it's now the time to buy. And in hindsight, we had 11 more months of pain with those stocks, but then they came back strong in 23 and 24. So, yeah, be patient. And if you look at valuations and if you look at trailing returns of how well they've done, this is just a small pullback in the big picture.
So I have to come up with some new questions, huh, Bob?
You can do that one once every 3.25 years. That's
All
fair.
right.
I'll see you in
Well,
2027,
all
28.
right. Well, same things keep happening over and over, and it's just a good reminder. So, what jumps out at you as you reviewed how different asset classes have performed in the first quarter?
It's really the international performance being so strong. I mean, developed international up about 7%, while US is down 5. That's a big spread. It's a strong quarter. So that's a big one. And bonds coming through with, up almost 3% for a quarter for investment grade bonds. So what we do here typically, you could summarize as diversification. Don't put all your eggs in one basket, and it really paid off in the first quarter. With when U.S. was weak, the other assets in the portfolio, namely non-U.S. stocks and bonds, came through in a big way, which is nice to see.
So there must have been a big move down in rates in the first quarter, Bob, right? To lead to those, would you say 2.7% returns?
2.78 for
Yeah,
the
2.8.
aggregate index. Yeah.
And so big move in yields,
Yeah, decline in rates in addition to collecting coupons now that are around 4 to 5%.
which
And
somewhat offsets Q4, right? Q4 we had a big move in rates in the opposite direction, which I believe turned the bond market slightly negative, even though it had been tracking to a good year up until then.
yes, yes, in Q4, exactly. In Q4, I think post-election, there was a run-up in rates as inflationary risks. The market was anticipating higher growth and higher inflation. And then I'd say in Q1, inflation has come in on the higher end, but growth estimates have come in lower. So it's cooled off on that front.
So, all in all, are you fairly optimistic, neutral, pessimistic about, the market for the rest of the year? A diversified portfolio, not necessarily US large cap, and any concerns with the economy based on the things that we've been talking about today and, the last 2 months?
Yeah, we're not seeing any terribly concerning news with the economy. It's not like recession indicators are flashing. It's just more of the political uncertainty,
Okay.
which some clients like to talk about and worry about a lot. And it's a tough topic to navigate because it's exactly that. It's uncertainty, and markets do not like uncertainty. They like to know what the rules are. They like to know what's going on, and um, just the lack of clarity from the White House is uneasy for markets. The good news that I would say, what gives me some optimism is I've heard from Secretary Besant, I believe Commerce Secretary, and Trump. They've all used phrases like we're in a period of transition and a detox period. And they've said things like the first 2 quarters of GDP, well, that's Biden's economy because it takes time for our policies to impact the economy. And if you think about it, if they have a long list of actions that they want to take, and some are more stimulative and some are more restrictive, what it seems like they are doing, or some lead to greater uncertainty, what it seems like they're doing is implementing the more restrictive policies first, the ones that increase uncertainty first, and then the more favorable ones will come later. And there's a term in finance like big bath accounting. If you have a bad quarter, just throw it all in there and apologize to investors. And yeah, this is gonna be a bad quarter, and I'm sorry, but then get it all out of the way so that next quarter is clear. And I think there might be some of that where they're kind of getting through the hard work now, and then the more pleasant things for the economy and stock market, like tax cuts, that'll come later. And so hopefully we see more transparency, less uncertainty in the future. Although one caveat with tax cuts is we're probably looking more at an extension of the Tax Cuts and Jobs Act, which is, you could call it still good news for the economy, but it's not good news like it was in 2017 because it's more just maintaining status quo as opposed to net new money into the economy. But I do think they are trying to do something like that, where it's get the bad out of the way first, followed by the good. So, if just keep making it through, Q2, one day in, and then maybe things will be a little bit better.
Great. I like the optimism, Bob, even though you didn't get your bowl of oatmeal to start the day. So, do you want to transition to our second topic, which is an overview of direct indexing?
Yeah, so with direct indexing, many people are familiar with the S&P 500 as an example. And one way to invest in the S&P 500 is through a mutual fund, or you can buy an ETF, like SPY is a ETF, one ticker or Vanguard 500, one symbol, and it owns the S&P 500 stocks. And the good of that is it's very simple to do and it's low cost and it gets you broad diversification and it's tax efficient. So there's a lot of good and simplicity that comes with it. Um, a slightly different way of doing that is a strategy called direct indexing, where rather than buying, just call it SPY, you're hiring a manager and they'll buy typically maybe 350 out of the 500 stocks in the S&P. They won't buy every single one, but they'll buy enough and it'll be more of the larger ones within the index so that you get pretty close to the market return. They'll look to come within like plus or minus 1 or 2% on a calendar year basis. So if the S&P is up 10, you should be, within 11 to 9, maybe 12 to 8, but pretty close to in the ballpark. And there are a few advantages of this approach where you own the individual stocks. So you call it, if you have a Schwab account, you would see 350 positions rather than one, with the same objective of trying to deliver about the return of the S&P 500. So why would you do that? There's a few advantages. One is if you have any existing stocks. So say you bought Apple stock when the iPhone came out. You said, hey, this is a good device. I'm going to buy some Apple stock and see how it does. And you've done great with it. You can incorporate that into the portfolio. So the direct indexing manager doesn't buy Apple stock for you. Otherwise, if you own Apple stock on the side and then you buy SPY, well, guess what? One of the top holdings in SPY is it's Apple. So you're increasing your exposure to Apple. Or if you work for a public company and you have employer stock and like through an employer stock purchase plan, you can have the direct indexing manager, even without delivering the stock, just say, don't buy my company, whatever the ticker is. So you can work around existing holdings like that. That's one advantage. A second that gets to the theme of customization is if you have any preferences with companies, if there's companies you just don't want to own. I don't want to own companies that fill in the blank, that make guns, firearm manufacturers. You could have them do that easily. And then really probably the main benefit of it, why most people invest in a direct indexing approach, is for the tax benefit. Because when you invest in SPY, market goes up one year, goes down the next, goes up, and that's what the line item does. When you have 350 stocks, every year you're going to have some winners and some losers. When the market as a whole is up, probably most of your stocks will be up, but there will be some down, and vice versa. When the market as a whole is down, you'll still probably have some winners. So by having greater dispersion within your portfolio, you have some stocks that are up a lot and some that are down a lot. And what the manager does is it takes a basket of the losers on about a monthly basis and sells them. And I said they buy 350 or so out of the 500, not all 500, so that they can then buy some of the ones that they don't own. So for example, say they buy Coca-Cola and Home Depot and both are down. They didn't buy Pepsi and Lowe's. So then they sell Coca-Cola and Home Depot at a loss and they buy Pepsi and Lowe's that are new positions. And in doing so, they're maintaining the sector exposure. So not disrupting the market exposure of the portfolio while the names are changing. Overall, the portfolio looks the same, but they're realizing capital losses for you on your tax return. So on your 1099, really. So they'll trade the portfolio actively like this, swapping in and out of the names that are declining to book losses, and then the ones that are appreciated and have gains, they'll hold. And those, if you're charitably inclined, have a donor advised fund, those are good targets to gift in the future, as you have really big winners. Because again, with 350 stocks, you're going to have the high flyers on one end and the big losers on the other end. So it helps with that. And overall, the strategy can deliver results where you get close to the market return and you're producing losses on your 1099 each year. So it's like a very tax efficient index fund in a sense is the goal.
Great overview, Bob. I really appreciate that. So when you talk about close to the market return, what type of tracking error should people expect? And maybe explain tracking error as a starting point.
Yeah, so tracking error, if you think of like a bell curve, a normal distribution, the measure of tracking error is how different you are from an index. So if I say tracking error of 1%, it's a one standard deviation event in a normal distribution is 1% of the benchmark. And one standard deviation event covers about 68% of outcomes. A two standard deviation event, which covers 95% of outcomes, would be double. So if your tracking error is one, a two standard deviation event is plus or minus 2%. So for a direct indexing approach, you typically see tracking error of 1 to 2%. So doubling that, 2 to 4% in a two standard deviation event relative to benchmarks. So pretty close.
And that's because of the way that they are replacing securities,
Yeah,
essentially.
by owning 350 and not 500, and then not having exposure at all times. So if Apple's down and then you sell the Apple and you replace it with something else, and then in like the 30 days that you out of the name, it jumps up, that there will be some tracking error there. When we look at it in aggregate, it is more noise, meaning it's not like a expected underperformance by 1 to 2%. It's not an expected outperformance by 1 to 2%. It pretty much washes. So when you like look at manager composites, you typically see that they come in right around the index, just with some dispersion that some will be a little below, some will be a little above.
And when is this a good fit for a client?
It's a good question. The best fit would be really two different scenarios. Someone selling a business, they have a lot of cash, and also they have big capital gains, either coming due now or in the future from outside of their portfolio, and they could use some losses. You fund the account, it generates losses, helps lessen your tax bill. So that's one. So just to state it simply, someone with a big capital gain event coming down the road and cash in hand today. And the second would be if you have a basket of what we call legacy securities, where you have stocks with large capital gains that, I bought these years ago. I've done well in them. I don't want to sell them for the taxes, but I also have some cash to invest. Can you kind of package up the cash plus these stocks and make a diversified portfolio? And that's when it's a nice fit. Whereas if you were to put that cash into funds or ETFs, you're probably doubling down in your exposure to the existing stocks. So a direct manager can integrate the stocks nicely.
So there's a lot of trading in these accounts. Are people paying for these trades? Is this kind of costing them? How do they price it, the managers who do this?
No, this is a benefit of the custodial wars over the last decade or so. Years ago, that they would have, but stocks now trade for free at Charles Schwab. So there's no trading cost. There might be like exchange fees in the pennies, but not even getting up to the dollars. There's bid-ask spreads. So just being careful with compliance here is it's not like you can't maybe say trading is
But
exactly.
this isn't you're doing hundreds of trades a year at 20 bucks a month or
No,
20 bucks a pop. Yeah.
no, you're talking pennies to transact. So yeah, advice for anyone who does this, please subscribe to online e-delivery. Otherwise, your mailbox will be stuffed.
Yeah.
Long statements, long 1099s, a lot of trade confirms. But it's a good solution, and it's nice when we find solutions that are combine financial planning with investment management, and I think this is one of them.
So there are various providers that you can utilize for direct indexing. What should people look for in a provider if they're not going to implement it directly with us?
Yeah, it's a good question. And we've seen quite a lot of growth in this space, not just from the existing providers, but more new entrants. There's a lot of asset managers I think are having trouble with their actively managed products where, they have a team and they pick their best 50 stocks and they haven't done so well. Whereas direct indexing resonates with people. So there's a lot of, come latelys. So I do think experience in this space matters. So I would look at how long have you been doing this? What are the assets that you manage in this strategy? And if you do that, it really boils down to just a couple of providers that this is, and is this your core business?
Okay.
So that's what we look at for firms, that this is what they do. It's a core business. They've done it for a while. They do it well. Looking at tracking error is important, like looking at composite tracking error data, and fees matter, of course. So looking at fees. So the manager that we prefer has been doing this for decades, manages tens of billions of dollars. We've negotiated very low fees, and they have tight tracking error. So that's kind of our short list.
So there's a more complicated flavor of direct indexing
There is.
that is utilizes leverage, but the use of that leverage and going short theoretically allows you to build a deeper pool of losses, and also I believe allows you to fund it with securities that have appreciated and not just cash. So I know it's very technical, but maybe just a high level overview of what some of the that this other flavor could be.
Yeah, so first, maybe just wrapping up the call it vanilla direct indexing approach. The one main drawback I would say to it is eventually over time, and call it 10 years, the strategy starts to what I call run out of gas, where you buy a basket of stocks, some go up, some go down, you sell the losers, you buy new stocks, some go up, some go down, and eventually you have only big winners in your portfolio, and the manager's ability to generate losses is pretty much diminished. They still reinvest dividends, so you have some additional ability to generate losses, but it's pretty minimal as you go out close to 10 years. And so I bring that up to be aware of it, but also that's where doing what's called the long short extension, which is what you're talking about, Sammy. So we're not talking vanilla anymore. This is a much more complex flavor of ice cream. What this is you have the core portfolio that people are familiar with, your traditional, say I have $1 million in this account, like that's the core and of stocks. And then they will borrow and lever long, and they'll also short stocks. So the structure will look like what's called a 140/40. So 140% long exposure and 40% short exposure. So shorting stocks is investing, borrowing them. So you profit if the price declines and you lose money if the price goes up. But meanwhile, you're levered long. So you have $140 long to your $40 short. And by implementing what's called the long short extensions, which it's that call it that surplus money on the long side and on the short side. What you're doing is you're getting more market exposure, more ability to generate losses, and also you can build around an incumbent portfolio. So, for example, if you have a basket of stocks and say you don't have any cash, I invested in all these stocks decades ago, they've done really well, and that's my portfolio. And I don't want you guys to sell them because that would incur gains. You can take that portfolio and then build out the long short extensions. And with the long short extensions, what the manager would do is they wouldn't just short indices and go long indices because that would wash. They look at the stocks, and today a lot of people are long tech stocks that they bought a decade ago and have done well. So say you have a basket of tech stocks that have done well. Your short book would be short different technology stocks. So say you're long Nvidia with a big gain, they might go short Broadcom as an example. So in addition to other technology sector stocks that are more correlated to your concentrated positions, and then your long extension would be sectors that you don't have exposure to, get energy, financials, utilities, etc. in there. So the whole package looks more diversified. And then they're doing the tax loss harvesting just like the direct indexing manager does within the long book and within the short book. And by having both exposures, it doesn't matter which way markets move because there will be losses on one side of the equation. So they generate losses on the extensions, then it helps trim the core portfolio, like your concentrated position in NVIDIA, as an example, and get a more diversified overall portfolio. It's a pretty complex strategy. If anyone's interested, that would, I think, be a longer discussion than we could fully cover on a podcast, but that's kind of a sneak peek to something that we've been working on.
That's a great overview. And I've been talking to business owner and real estate investors about direct indexing for that very first use case that you described. I think it's a good strategy when applied correctly and we build a portfolio around it. I think the direct indexing exposures, primarily, if not exclusively U.S. stocks, which if you've been listening to the podcast and you know us, we have international, developed international, emerging markets, fixed income, real assets. So it's going to be a sleeve of the portfolio. We'll use it within the U.S. space. We'll build a portfolio around it, and it's something that has resonated with people who want to keep more of what they earn from a transaction down the road.
That's right.
All right, Bob, anything else on your mind in terms of just the either the outlook, what people should be watching day to day or week to week?
What people should be watching day to day or week to week. I would take that comment to say, just stay out of politics in your portfolio. It's not healthy. And we've just seen time and time again, people get worked up over politics and then worry about their investments. And it's typically an unhealthy cycle. So I would just try and detach the two. But otherwise, I think we're good for today.
All right, thank you, Bob. I really appreciate the time, and as I know our listeners do as well.
All right, thanks, Sammy.
Thank you for listening to Wealthy Behavior. If you found the conversation useful, please leave a review wherever you listen to your podcasts and share this episode so those around you can live a rich life too. We appreciate your feedback and questions. Please email us at wealthybehavior@heritagefinancial.net. For more insights, subscribe to our weekly blog at heritagefinancial.net and follow us on Facebook, Twitter, and LinkedIn. Check out my personal finance blog at thebostonadvisor.com. Wealthy Behavior is produced by Kristen Kastner and Michelle Kakamis.
This educational podcast is brought to you by Heritage Financial Services, LLC, located in the greater Boston area. The views and opinions expressed in this podcast are that of the speaker, are subject to change, and do not constitute investment advice or a recommendation regarding any specific product or security. There is no guarantee that any investment or strategy discussed will be successful or will achieve any particular level of results. Investing involves risks, including the potential loss of principal. There has not been and will not be any compensation exchanged between Heritage Financial Services and podcast guests or recommended resources.